Chapter 1 Cliff Notes Basic Principles of Life and Health Insurance and Annuities. Types of insurance companies. Commercial, also known as private insurance companies, are in business of selling insurance for a profit. Commercial insurers offer many lines of insurance. Some sell primary life and annuities, while others sell accident, health insurance, or property casualty insurance. An insurance company sells more than one line of insurance, known as multi-line insurers. Commercial insurance is divided into two main groups: stock and mutual insurer. Stock companies are organized and incorporated under state law for the purpose of making a profit for its stockholders/shareholders. Traditional stock insurers are called non-participating insurers because policy holders do not participate in receiving dividends or electing the board of directors unless they are also a stockholder of the company. When declared, stock dividends are paid to stockholders in a stock company. The directors and officers are responsible to the stockholders. Transformation of stock insurers into a mutual insurer is termed mutualization, and the reverse term is demutualization. Dividends from a stock insurer subject to taxation because they are considered profit. Mutual companies are owned by their policyholders. Mutual insurers are known as participating insurers because policy holders participate in receiving dividends and electing the board of directors. When declared, mutual companies' dividends are paid to the policyholders. Dividends from a mutual insurer are not subject to taxation because the dividends are considered to be a return of a premium. The only exception is if the policy owner chooses to let the dividends sit and collect interest. In this case, the only accumulated interest would be taxable. If a company operates as both participating and non-participating insurers, that they are known as mixed insurers. Dividends can never be guaranteed regardless of the type of company offering them. Strong assessment mutual companies are classified by the way the change premium. A pure assessment mutual company offers basic long sharing by group members. No premium is paid in advance. Instead, each member is assessed an individual portion of losses that occur. An advantage premium assessment mutual change a premium at the beginning of the policy period. If the original premium exceeds the operating expense and losses, the surplus is returned to the policy holder as dividends. However, if total premiums are not enough to meet losses, additional assessments are levied against the member. Normally, the amount of the assess that may be levied is limited either by state law or simply as a provision in the insurer by law. Fractional benefit society are special types of mutual companies, non-profit, religious, ethnical, or charitable organizations that provide insurance solely to their members. Fractional must be formed for a reason other than obtaining insurance. An example of a fractional society would be Knights of Columbus. Risk retention groups are mutual companies formed by a group of people in the same industry or professional. Examples would be pharmacists, dentists, and engineers. Service providers offer benefits to subscribers in return for payment of premium. These services are packaged into various plans, and these who purchase the plans are known as subscribers. Example of service providers are health maintenance organizations, HMO, and preferred provider organization, PPO. Reciprocal insurers are unincorporated groups of individual members that provide insurance for other members through indemnity contracts. Each member acts as both insurer and insured and are managed by attorney-in-fact. Reinsurer makes agreements with other insurance companies to transfer a portion of their risk to the reinsurer. The company transferring the risk is called the ceding company, and the company assuming the risk is the reinsurer. Captive insurer is an insurer established and owned by a parent company to insure the parent company's loss exposure. Home insurance, also known as industrial insurance, is sold by home service or debt life insurance companies. Face amounts are small, usually $1,000 to $2,000, and premiums are paid weekly. Government insurance. Federal, state governments are also insurers. They provide social insurance programs to protect against universal risk of redistributing income to help people who cannot afford the cost of incurring such losses themselves. These programs have far-reaching effects, and millions of people depend on them. Types of government insurance include Social Security, Old Age Survivor Disability Insurance, OASDI, provides insurance benefits for elderly, retired, survivors of those who died young, child of decedent parent, and those qualifying for federal disability. Medicaid, health insurance care for the elderly. Medicare, health insurance care for the elderly. Medicaid, health insurance to aid the financially needy. SGLI and VGLI, serviceman's or veterans group life insurance. Life insurance for active and retired members of the military. TRICARE, health insurance for members of the military and their family. Self-insurers retain risk and must have a large number of similar risks and enough capital to pay claims. However, they may save money if the loss experience is lower than the expected costs. Self-insurers are not a method of transferring risk. Rather, self-insurers establish their own self-funded plan to cover potential loss. A self-funded plan is a plan in which an employer pays insurance benefits from a fund derived from the employer's current revenue. Lloyd's of London is not an insurance company. Members of the association from syndicate to underwrite and issue insurance-like coverage. This group is a group of investors who share in unusual risk. How insurance is sold. Distribution systems are the way insurance products are marketed and sold to the public. Insurance can be purchased through licensed insurance producers who are either agents or brokers, or through a number of other ways. Agents are either captive career agents or independent agents. Captive agents work for only one insurer. Independent agents work for themselves or for several insurance non-exclusively. Career agency systems. With the career agency system, commercial insurance establish offices in certain locations. Career agents are recruiting to work at these locations. A general agent hires and trains new products and supervises a number of other product producers, and or all producers under the career agency system are captive agents and employees of the insurer. Personal producing general agency system. With the personal producing general agency (PPGA) system, agents work for an independent agency selling policies from several insurance companies. Unlike the career agency system, agents are not employees of the insurance company. Instead, they work for PPGA. Furthermore, personal producing general agents primarily sell insurance instead of recruiting and training new agents, as in the career agents system. Independent agent systems. American agency system. Independent agents represent a number of insurance companies under separate contract agreement. They may also work for themselves under other insurance agents. Independent insurance agents have control and ownership over their clients' accounts. This means they may place clients' businesses with a different insurer when policies are up for renewal. Independent insurance agencies earn commission on the sales, and they make and override sales made by agents they manage. Managing systems. With the managing system branch, officials are established in several locations. Instead of a general agent running the agency, a salaried branch manager is employed by the insurer. The branch manager supervises the agent working out of that branch office. The insurer pays the branch manager salary and pays him a bonus based on the amount and type of insurance sold and the number of new agents hired. Mass marketing. Another way to sell insurance is through mass marketing. Direct sell or direct mail is a mass marketing method where agents are not used. Instead, policies are marked and sold through television and radio advertisements, printed sources found in newspapers and magazines, by mail in vending machines, and over the internet. Industrial oversight and regulation. The insurance industrial is primarily regulated on a state-by-state basis with minimum federal oversight. The primary purpose of this regulation is to promote public welfare and provide consumers protections and ensure fair trade practices, contracts, and prices. Key history events that have shaped the current regulation include 1869, Paul versus Virginia. The U.S. Supreme Court ruled that insurance transactions crossing the state line are not interstate commerce. 1905, the Armstrong Investigation Act gave the authority to the state regulate insurance. Gave the authority to states to regulate insurance. 1944, United States versus Southeastern Underwriters Association ruled that insurance transactions crossing state lines are interstate commerce and are subject to federal regulation. Thus, many federal laws were conflicting with existing state laws. However, this decision did not affect the power of the state to regulate insurance. 1945 McCarran-Farragut Act states that while the federal government has authorized to regulate the insurance industry, it would not exercise its right. If the insurance industry was regulated effectively and adequately on the state level under the McCarran-Farragut Act, the minimum penalty of a producer who has obtained personal information about a client without having a legitimate reason to do so is a fine of $10,000. 1970 Fair Credit Reporting Act provides individuals primary protection and fair and accurate credit reporting. Insurance companies are required to notify applicants if a credit check will be made on them. Under the Fair Credit Reporting Act, the maximum penalty of a producer who has obtained consumer information reporting under false pretenses is a fine of $5,000. 1999 Graham-Leach-Billy Act, Financial Service Modernization Act. This law repeals the Glass-Steagall Act. This allows banks, retail brokers, and insurance companies to enter each other's line of business. 2001 U.S. Patriot Act, uniting and strengthening America by providing appropriate tools requiring to intercept and obstruct terrorism act as it relates to the insurance industry is designated to detect and deter terrorists and their funding by imposing anti-money laundering requirements on brokerage firms and financial institutions. 2003 National Do Not Call Registry. Insurance calls are not exempt from the Not Call Registry. 2010 Patient Protection Affordable Care, PPACA, often shortened to the Affordable Care Act, ACA, represents one of the most significant regulatory overhauls and expansion of coverage in the U.S. history. The National Association of Insurance Commissioners, NAIC, is an organized composed of insurance commissioners from all 50 states, the District of Columbia, and 4 U.S. territories. They are responsible for recommending appropriate laws and regulation. They are responsible for the creation of advertising codes and Unfair Trade Practice Act and the Medicare Supplement Insurance Minimum Standards Model Act. NAIC has 4 broad objectives: to encourage the uniformity in state insurance law and regulation, to assist in the administration of those laws and regulations to promote efficiency, to protect the interest of the policyholder and consumer, to protect state regulation and insurance business. Advertising codes. The code specifies certain words and phrases that are considered misleading and are not to be used in advertising of any kind. Unfair Trade Practice Act gives chief financial officers the power to investigate insurance companies and producers to impose penalties. In addition to that, the act gives officers the authority to seek a court injustice to restrain insurers from using any method believed to be unfair. NAIF, National Association of Insurance and Financial Advisors, and NAHU, National Association of Health underwriters. Member of the organizations are life and health agencies dedicated to support the industry and advancing the quality of service providers by insurance professionals. These organizations create a code of ethics detailing the expectations of the agencies in their duties towards clients. To sell, each state requires a high level of professionalism and ethics. Some of these standards and ethics are: selling to need agencies must first determine the consumer's needs, that then determine which policy fits their needs best. Suitable of recommended products. An ethical agent must be able to access the correlation between a recommended product and the consumer's needs. Full and accurate disclosure of an ethical agent must inform consumers of the benefits and limitations of recommended products. Recommendations must be accurately and completely clear. Documentation: an ethical agent must document each client meeting and transaction. Client service: an ethical agent must know that a sale does not mark the end of the relationship, but rather the beginning of the relationship. Therefore, routine follow-up calls are recommended. Buyer's guide: each state requires agents to deliver a buyer's guide to consumers that explain various types of life insurance products and other information on the recommended policies, such as premiums, dividends, and benefit amounts. Policy summary: help consumers evaluate the suitability of the recommended products. Reservations are the accounting measurements of an insurer's future obligation to its policyholders. There are classified as liabilities on insurance company accounting states, since they must be settled at a future date. Reserves are set aside by an insurance company and designated for payment of future claims. Liquidity: an insurer's ability to make unpredictable payouts to policyholders. Guarantee associations are established by all states to support insurers and protect consumers in case an insurer becomes insolvent. State life and health guarantees are associations provide a safe net for all members. Life, health, and annuity insurance in a particular state. Guarantee associations protect insurers in the event of the insurer's insolvency or inability to pay claim up to a certain limit. Independent rating services are credit rating agencies that rate or grade the financial grade, strength, and stability of insurance based on claims, reservations, and company profits. The national recognition strategically rated organization that rate insurers are AM, Best, Moody, Standard and Poor, and Fitch ratings. Each rating service has its own system, but most use an A to F letter grade scheme.